What's up everyone, it's Kadi with MoneyVest. So in this video, we are going to be talking about Tesla stock, which is apparently being shorted again by one of the investors. However, they are still bullish, which I'm going to break down in this video. And I'm also going to talk about the upcoming earnings. We're going to take a look at the earnings expectations, revenue expectations, and also discuss why it is going to become increasingly difficult for Tesla to operate in this environment, right? Because we know that interest rates are higher. And I'm going to break down exactly the reason or basically the idea that a lot of people don't understand with respect to interest rates. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. All I'm asking in return is that you drop a like and of course subscribe to the channel. And again, links to our Discord and Patreon is going to be down below if you're interested in joining us and our community, and you get access to all the buy and sell alerts, options alerts, trade ideas, members only private videos, the trading view charts, the stock analysis reports. Everything is going to be included with the link down below. And I want to remind everyone that if you do sign up before the end of this year, before December 2023, you also get early access to our beta launch that we are going to have for MoneyVest.com in 2024. So super excited to share that as well. And again, link's going to be down below. So this right here, hedge fund manager Dan Niles is short Tesla as stock rises 5% this month. So I mentioned this in one of my other updates, and a lot of people confused it with Dan Ives. So Dan Ives is an analyst for Wedbush Securities. We've had him on the channel to interview about, tech stocks and whatnot. So he's not shorting Tesla, right? He is still very much, I think, bullish on Tesla. But this is a different person, Dan Niles, hedge fund manager. He's the one who's actually shorting Tesla. And he said, Dan Niles revealed that he is still shorting Tesla stock despite being bullish on the broader market. Niles, co-founder and portfolio manager at Satori Fund, Tuesday that he sees significant headwinds, told Tuesday to CNBC that he sees significant headwinds for Tesla in the months ahead that could push the stock lower. And having more than doubled in value this year, Niles said the stock now faces a very, very different environment to earlier this year. Specifically, he cited surging interest rates with the 10-year treasuries spiking to over 4.8% recently and creating a challenging backdrop for auto sales. And rising interest rates have pushed the typical new vehicle loan interest rates to 9.62%. And its data shows that it now takes 42 weeks of median income to purchase a new car, up from an average 34 weeks before the pandemic. And that is a big problem, right? So this directly affects the demand for vehicles. Not only for vehicles, this kind of trickles into everything else, right? As we know that, as cost of borrowing goes up, consumer starts to pull back and recede a little bit on those purchases. And that creates this environment where if the demand starts fading, what does the company have to do to meet their targets and revenues while they start lowering the price? And that is in a nutshell is demand and supply, right? That's how it works. And that's exactly how monetary policy works, is to raise interest rates in order to force people to spend less. And as they spend less, the demand starts to fade back and supply kind of gets into more equilibrium. Prices maybe come down. And as a result, inflation will be lower. So that is the whole idea. And the problem with this, and I want to talk about why interest rates going up is not an issue. It's not an issue, okay? It's actually, the interest rates going up does not do any damage to the economy. And I'll go over what actually does the damage. So he says that higher financing costs driving up the cost of cars for the average consumer, combined with the fact that stock is up a lot, we think it's a good relative short paired with the lot of other names that we are long in technology. And we know that Tesla delivered 435,000 cars in the third quarter. And the revenue expectations, I believe, is going to be, so we can just bring this up. Tesla here, as you can see, that the revenue expectations for going into next week, and they're reporting on Wednesday, October 18th, is going to be 24.2 billion. And EPS is going to be a little bit over 73 cents per share. So that's going to be the revenue and the earnings per share estimates going into next week. And I've already, done the technical analysis and the fact that it's, a little bit of that symmetrical triangle formation while also validating that 100 simple moving average. We'll get back to that in just a minute. But that was a very nice growth of over 29% on a year-over-year basis for the company, even though they came in less than expected compared to the expectations and the consensus. Year over year, we still grew really nicely. Now, the lower delivery numbers were released despite price cuts of its Model 3 and Model Y vehicles earlier this year. Together, Niles said the statistics were indicative of there being continued pressure on gross margins going into the future. And that's been a long standing over the last 6 to 12 months, 5 quarters, in fact, a big problem for Tesla is margins coming down because of price cuts. And he, goes on by saying that we like the company. I own a Tesla. I own a Model X, and I think it's a great product. I think Elon Musk is the Thomas Edison of our generation. I love the company. I just think the stock is expensive, given the estimates have to probably come lower. And that's a fair assessment to make, right? And as I said before, in investing, there's no black or white, right? There's a very gray area where you can like the stock, like the company, you can like the management, you can like the CEO, you can like the product, and still believe the stock is too expensive, right? And it's the same thing with, well, it doesn't really work with the other way around. If you don't like the company, if you don't like the product, regardless of how cheap the stock is, it's not going to convince you to actually take a bullish position on that company, right? But on the other hand, it does work in that way where you can have a company that's phenomenal, it's fantastic, it's A+ product, excellent quality, but the stock being too expensive can lead you to that position where you start looking at potential opportunities of shorting it. Now, so I don't disagree with that standing. I don't disagree with that analysis. He does also mention that he's currently bullish on the overall market, but of course he is shorting Tesla. Now, this right here is the 42 weeks of income needed to purchase a new light vehicle, which is again almost a year. I mean, 52 weeks in a year, 10 weeks short of how much income is needed in order to finance a vehicle. And you'll notice that majority of the time we've been sitting at 36 months. That's been the long-standing average. And this is, also related to the auto rates, which were sitting at 3, 4, 5% for a very long time. You see, when interest rates go up, right, that's not when the damage is done. That's not when the damage is done. And we'll talk about some of the rates right now. So you'll notice 781 to 850 credit scores at over 7% used car loans and over 5% new car loans. Right? These are the credit scores, and this is how much the current interest rates are depending on the credit score a person has. 661, 780, we're looking at 6.4%, but anything that's under 660, you're paying 9% or higher in a new car loan and over 13.5% in used car market. This is the breakdown of the US population broken down by FICO scores, FICO credit scores, and you'll notice that under 700, we're looking at 21, plus under 728, plus under 6, we're looking at 34, 37. So almost 40% of the population is sitting at under a 700 credit score. So under a 700 credit score, you are most likely working with anything that's over 6% or higher for your loan, right? And of course, these can be refinanced at a later date when the rates are lower. But let me explain to you how it is not damaging when rates go up. So the damage does not happen when rates go up. The damage happens when interest rates stay up. Okay? It's a huge difference because if interest rates go up and they come back down, there hasn't been enough time for the economy, for the market, for the consumers to adapt to the higher interest rates because they went up and they came back down. The problem really happens when interest rates go up and they stay up, right, for longer. And that is when it starts to trickle into the new norm, right? The new environment, the new interest rate environment that we're in is going to start playing a much bigger and bigger role in the economy. So for example, you'll notice that for the majority of the time, the markets were accustomed to interest rates staying so low for auto loans that the average weeks of income needed was around 32 to 36, right? So the average can be 34. And that's since 2012, right? All the way through 2021. But now, if interest rates stay higher for longer, they don't come down, well, this is going to be the new norm. And you don't think the market's going to shift? Of course it is. This is the new high or the new environment that the markets would be dealing with, the economy would be dealing with. That's obviously going to affect demand, right? This is all demand and supply. And if demand starts to come back, well, Tesla unfortunately would be forced to once again maybe cut more prices to increase that desire for people to go out there and start buying electric vehicles and more specifically buy Teslas. So, this is a very, very important issue because a lot of airline companies, a lot of transportation companies, logistics companies, pretty much every company uses a 3-month, 6-month, 12-month average of interest rates and prices, right? Oil prices staying up is a big issue, right? Oil prices going up is not an issue. If it's staying up, that's an issue because a lot of airline companies use a 3-month or a 6-month average to price their own jet fuel that they're charging from customers, right? So if it doesn't come down and it doesn't stay down, right, that's going to be a potential problem from an economic standpoint, because that is going to create this new reality where interest rates and prices are higher for longer. And that's exactly what Jamie Dimon also mentioned in his warning, that we need to be prepared for an environment where interest rates and prices stay higher for longer. And this could be the new reality that people are facing. So Tesla, unfortunately, has had to cut prices over and over and over again. We've gone through several price cuts. And that's being affected in the margins. I mean, it's not because the costs are coming down. To some extent, yes, they are. I mean, cost of batteries and everything's becoming more efficient. So there's an argument to be made that yes, costs are indeed coming down. But at the same time, if that were the case, the price and the costs are not coming down to the same level, right? The rate of decrease in cost is not equivalent to the rate of decrease in the prices. So Tesla is basically being more aggressive at price cuts as opposed to the cost cuts that they're witnessing or experiencing. So what that does to the margins, it squeezes them out, right? So that's exactly what we have seen. Operating margins gone from 14.6 to now under 10%. Total gross margins from 25 to under 19%. So we have seen about 5 to 6% compression in margins over the last 5 quarters, which is an issue, right? It's an issue from a profitability standpoint. Now, understand why Elon Musk is doing this, right? He wants to hit those delivery volumes. He wants to get to, 1.8, 2 million vehicles, 4 million, 5 million. So in the future, I wouldn't be surprised if he does more price cuts to kind of accelerate that demand, only if interest rates stay higher for longer. So that's a big macro play here as well, because I don't want any company to be dependent on the macros or monetary policy to justify making sales, right? If a company's entire thesis, right, or a fund's entire thesis depends on macroeconomics, there's a problem, right? There's maybe a subjective argument there that you want to create a product so good, so desirable, that regardless of where interest rates are, people are dying to buy your product, right? And that's more subjective, right? I don't know if Tesla's there yet. I don't know if interest rates getting up to 10%, 12%, regardless of where interest rates are, people are going to be very enthusiastic in buying Teslas. Not sure if we're there yet. But in general, right, from a mathematical perspective, if interest rates go higher, that's not a problem. If they stay higher for longer, that's a problem. And that's going to create lower demand, which could lead to lower prices, which could lead to margin compression even further, which could lead to lower earnings, which could lead to higher multiples, which could lead to stock prices coming down. So that's the whole chain of thought that I want you guys to understand and follow along with. And that's exactly what's happening at the moment. Now, going over to the technical analysis, this right here is the entire breakdown. We've already talked about the fact that Tesla's been on a very nice uptrend. However, recently, though, it's showing signs of some weakness with this lower high and this lower low, and we've got a massive supply and a resistance sitting in the 280s to as much as $320. And of course, support level is going to stay put in the low 200s between $208 and $220. So this right here is going to be that support level to watch for Tesla, and of course, right now sitting right above its 100 simple moving average. So going into next week, if we do see some more selling pressure, earnings are coming out, so that's going to be very, very important. If margins compress, if operating margins dips below 9%, that is going to be an issue for Tesla, in my opinion. So yeah, I mean, next week we'll be talking about Tesla and Netflix and a lot of other companies that are reporting earnings. But let me know your thoughts down in the comment section below, and what do you think about Tesla? Are you buying, selling, or holding right now? Let us know in the comment section down below. Don't forget, links to our Discord and Patreon is going to be down below. So always happy investing. I'll see you all in the next video.